Very good morning, students. Welcome back to my channel. Today we will study the remaining topics of the Indian money market. In my previous video, we had already covered three different sub-markets of Indian money market. That is call money market, repo market and the certificate of deposits. Today in this video, we will going to discuss treasury bills, commercial papers, discount and finance houses of India. What are the deficiencies of Indian money market and what are the recent trends? So let's start. First, you know that government borrows money. They borrow money in two forms. One is short-term form, another is long-term. Short-term loan is taken with the help of treasury bills, whereas long-term loans are taken with the help of NSEs and KVPs. In NSEs and KVPs, household sector and individuals can participate, but treasury bills cannot be purchased by individual or the household sector. So let's start and discuss about the treasury bill, which is the part of Indian money market. Treasury bills are also known as gilt-edged securities or T-bills. So keep in your mind what is T-bill. T-bills are the government securities called treasury bills, also known as gilt-edged securities. So whenever government is short of funds, then government will borrow the funds from the banks. When government is borrowing the funds from the bank, they have to issue bills called treasury bills to the bank. These bills are issued with the help of RBI. So RBI issued treasury bills on the behalf of central government. First of all, in 1970, treasury bills are issued. The minimum amount of treasury bill is 25,000 and is issued in the multiple of 25,000. Maximum, there is no limit. At present, 91 days, 182 days and 364 days treasury bills are issued. These treasury bills are having the higher liquidity. There is no risk, readily available. They give assured yields, low transaction cost and are also eligible for the inclusion in the statutory liquidity ratio. So, what do you all know what is statutory liquidity ratio? Yes, I had already taught you in my monetary policy chapter. If you want, you can go through that video to understand what is SLR and CRR. Here, the treasury bills are the important bills which is called promissory note issued by the government of the India whenever they need fund. They give guarantee of the repayment. They are the risk-free securities. So I hope you all are able to understand now what are treasury bills. Next, government borrow money from RBI. If it is borrowed for 90 days, then it is called wages and mean advances. And the rate applicable here is called repo rate. But when government borrows from RBI for 10 days, then the interest rate is 2 plus repo rate. This is called overdraft. Means if government has borrowed money from the RBI and they are not able to returning it to the RBI after 90 days, then what will happen? Government will ask the RBI to extend the time period. Then RBI will give 10 days extra to the government for returning the amount. So this is called overdraft. Here the rate will be 2% more than the repo rate. Next is commercial paper. Whenever corporates borrow money from the bank, then the corporates issue one paper that is called commercial paper, on which they will write the interest rate and the maturity period. First of all, commercial paper was issued in 1990. So what will happen? Corporates will give CPs and bank will give money. So the corporate will give commercial papers to the bank, whereas bank will give money to the corporates. These papers are called commercial papers. These are highly safe and liquid. Other names of commercial paper are industrial papers, finance paper or corporate paper. But they are unsecured promissory notes. Commercial papers can be issued only by those companies whose net worth is more than 5 crores. So, the companies whose net worth is more than 5 crores, only those companies can issue commercial papers. Commercial papers are issued in the multiple of 25 lakhs. Maximum, there is no limit. The maturity time of commercial paper varies from 3 months to 6 months. So, this is all about commercial papers. Now, let's discuss about the discount and the finance houses of India. So, DFHI was set up in 1988 to provide the liquidity to the money market instrument and to develop the secondary market. Initially, DFHI deals with 182 days Treasury Bills. They deploy repo facility to all Indian financial institutions like IDBI, IFCI and NABARD. The important function of DFHI are they act as both lender and borrower in the interbank call money market. They discount, rediscount, buy, sell and underwrite the marketable securities. They promote and support company funds trust for the development of the money market. They also give advice to the government, banks, financial institutions or business houses in evolving schemes for growth, development and expansion of the money market. Now, we will discuss about some deficiency that Indian money market is following. First, there is existence of unorganized sector in India. There is a lack of integration. So, integration is not there between the organized and unorganized money market. Absence of all India money market. Indian money market has not been organized into single integrated all India money market. It is divided into small segments like Kolkata, Delhi, Ahmedabad, Mumbai, Kanpur, etc. All these markets differ in their level of operation. There is also a seasonal shortage of fund. India is primarily an agriculture country. So, there are two seasons in agriculture, namely busy season and slack season. During the busy season, that is November to June, there is excess demand for credit. But during the slack season, there is scarcity of fund. So, there is no demand. Next, disparity in the interest rate. Interest rate in different money market are different. So, the money available at different rates in the different market. Inefficient and inadequate banking facility. Despite vast expansion in the banking industry, the banking facilities are inadequate and banking services are highly inefficient. Limited foreign funds. Though after the commencement of the liberalization, Indian money market has started attracting foreign funds, but the supply of foreign funds is too small. Absence of submarket. Sub-markets like discount houses, acceptance houses, bill brokers, these are not in existence in the Indian money market. Limited foreign funds that I already told you, inelasticity and instability. The Indian money market is inelastic and unstable. It is a restricted market. It is a narrow base with a limited number of participants, so not in the position to effectively mobilize the fund. And the last one is limited bill market. Both domestic and foreign bills are purchased and discounted by the commercial bank. However, such transactions are very small compared to the developed money market. They also constitute only a small pot of total money. So, a well organized bill market is very important for running the money market. In this way, these all points are the deficiencies of Indian money market. So now we will discuss about the recent trends or the reforms of the Indian money market. Today, the process of integration between the organized and unorganized money market have been started. So, the commercial banks are completely engaged in integrating both the sectors. Widening of the call money market. In recent times, many steps have been taken to widen the call money market. LIC, GIC, IDBI, UTI, specified mutual funds have been permitted to enter into this market as a lenders only. The DFHI and the STCI have been permitted to operate both as a lender and the borrower. Next, introduction of the new money market instruments. Slowly, new instruments are already launched in the money market. As you can see, Treasury Bills, commercial papers, certificate of deposit, these are the important money market instruments which are launched one by one to develop the money market. Later on, the repo rate and the reverse repos are also introduced. I told you a repo is an instrument of repurchase agreement between the RBI and the commercial bank. In 1992, repos are introduced, whereas in 1996, reverse repos are introduced. Promotion of the bill culture. All attempts have been taken to discourage cash credit and OD system of financing and to popularize bill financing. Exemption from the stamp duty is also given on the rediscounting of the bills. Introduction of the money market mutual fund. It was introduced in 1991. Money market mutual fund provides additional short-term avenues to the investor and bring money market instrument within the reach of individuals. Later on, DFHI and STCI was established. STCI was established in 1994 and DFHI was established in 1988. STCI is launched to provide good secondary market in the government securities, whereas discount and finance houses were established to provide liquidity to the money market instrument and to develop the secondary market. So in this way, these are the important trends of the Indian money market. I hope you all are able to understand now what is money market, what are the characteristics, what are the different instruments of money market, what are the recent trends and the deficiency of the money market in the India. If you have any query, then feel free to contact me. Thank you so much for today. Like, share and subscribe my channel. Thank you.
I think this is good.